Good morning and good afternoon, everyone. Welcome and thank you for joining us today for our virtual lease accounting workshop. My name is Colleen Tigas. I'm the General Manager of EZLease, and I will be your moderator for this session. So now it is my pleasure to introduce our presenter for this session, Bryan Sinclair, who is a Vice President Technical Accounting Leader at RGP. Bryan, I'm going to pass this over to you.
Great. Thank you very much, Colleen. Pleasure to meet everyone and hope you're enjoying the webinars. And I really, truly appreciate EZLease and LeaseAccelerator for providing this opportunity. On the screen now is just some of my background. But I think let's go ahead and move forward into the next slide and just go through the agenda. So from an agenda perspective, we're going to talk briefly what to consider when going public. That is, when we're considering an IPO or a SPAC or a direct listing, what are some of the activities and things that we need to be thinking about as we want to consider that journey? Secondly, we're going to talk some about the key lease accounting challenges that can affect the going public process, and then subsequently, once you are a public company, those challenges of continuing to comply with the lease accounting standards and ways to help alleviate that and leverage excellent tools such as the EZLease solution. Thirdly, how going public affects the lease accounting compliance. Again, similarly, what is impacted by the fact that you're going public? What does that mean around the lease accounting compliance and reporting? And then we're going to address a little bit around the pre and post IPO audit implications, because there are implications of becoming a public company, and what does that mean from your perspective as a company who's now getting ready to go public. And once you're public, the type of financial accounting, the audit, what the auditors generally expect, and of course, and then compliance with the SEC, that is the Securities Exchange Commission, in terms of their requirements to comply with their statutory requirements for financial reporting and compliance as a public company. Next slide, please.
All right, so we're going to do our first poll question here, start right into the poll question. So this is a good question, right? Are you planning to go public in the next 12 months? So Bryan, you and I have been doing this for a long time. We've been doing these types of presentations together here for, gosh, 7 years or so. You know, I think it's interesting because back when we first started doing this, you know, I don't even think SPACs were around. So, you know, now
great question. You know, certainly the idea of the blank check company, which is essentially what a SPAC is, or reverse mergers is ultimately what the transaction entails, have been around, but I think the attention, and not so much the attention, but just the sheer volume of SPACs has just grown tremendously in the past couple of years. If you saw the deal flow, I mean, it may be just less than 100 or a few hundred. And in the past couple of years, we've seen as many 600 to 700 SPACs go public in any one time or during the year. And so, yeah, it's just sheer amount of volume and capital that's flowed into the SPAC vehicle has been tremendous over the past 18 to 24 months.
Well, and I think this session is going to be really helpful for companies. You know, just doing the SPAC, it's kind of like doing an IPO really fast. Right?
Yes,
it's like you have a whole bunch of challenges, right? And then to layer the lease accounting challenges on top of it, because the lease accounting, that's all brand new and incremental work as well. So, you know, this is going to be a great session. So over half are not planning to do this in the next 12 months. But we definitely have everybody else is, you know, kind of spread out here, SPAC, IPO, and also considering both and not sure. So should be able to, at least half of the people are gonna get some great information coming up here. So let's go ahead on, and Bryan, I'll send it back over to you.
Great, thank you, Colleen. So yes, if you're considering going public, what are sort of some of the basic steps for success? And I've sort of broken it down in these three categories. First and foremost, the three Ps, people, process, and planning. I can't say enough about the preparation and planning that you really want to go, it needs to go into this process. Even if you are considering a SPAC, which, again, a special acquisition company path, which tends to be a very accelerated process to go public. You still want to start, if you're thinking about that in the future, you want to start preparing sooner rather than later. And that really starts with evaluating your current financial statements and compliance with current GAAP. Now, private companies will typically have their financial statements, if they're audited, will be audited what we've referred to as around private company standards. We sometimes refer to that as the AICPA standards. Well, there are certain U.S. GAAP provisions as well as SEC reporting requirements that are unique to being a public company or to public companies. And so all the consideration, the first step is considering then what around our financial reporting, what's around our financial statements would require an uplift, if you will, to what we refer then to as the PCAOB standard. The the PCAOB is the auditor of the auditors. And so that standard is a much more detailed, the materiality thresholds are much more in depth. The level of documentation and support required is much more substantial. And so generally, for every significant accounting position that you currently apply to your financial statements will need to be fully documented, analyzed, policy decisions that you've made, evaluation of previous transactions that are impacting the current period financial statements. All those need to be fully supported through some fairly detailed documentation, a memo or a white paper of some sort. Secondly, it's not all about the accounting and financial reporting, the accounting finance department. You really do want to evaluate the gaps and needs within other parts of the business that ultimately are very important as a public company. That could be your FP&A group, the ability to provide timely analysis of your results and being able to look forward into the future. Your IT solutions, your current IT solutions support the business adequately, knowing that now you're going to have a much more accelerated reporting requirement, a closing schedule. And once you become a public company, there's a max of a 45-day period that you have to file your Form 10Q, your quarterly report. And part of that is not only closing the books for the quarter, but it's getting through the audit committee, the board approvals, the auditors doing their quarterly review. All that needs to be accomplished within that 45 days before you file that 10Q. So it's evaluating, again, your IT and your IT support, the solutions you have in place. Areas like lease accounting, for example. Do you have the appropriate lease accounting solution that permits you to do a timely close? Those are all some of those considerations that are really important and that are not strictly tied to the accounting and financial reporting. And then think about other various stakeholder information needs. And you may think about investor relations. Again, those are all areas of that can have a positive, very positive impact on being a public company, having a consistent story that tells the analyst and investor community what you've done and what you're doing. And then thirdly, build it to last. Solid, reliable corporate governance. The listing. If you're listing on NASDAQ or listing on the New York Stock Exchange, they will have expectations and requirements as to what the board consists of and their capabilities. So does your board today have the functional requirements to be a board member of a public company? Secondly, really important to identify someone within the company to help manage those board members, the board matters, and bringing best practices to the communication with the board. And then that's an area that is so sometimes kind of ignored out of the gate that we've seen. And again, having ability to keep the board apprised of what's going on in the company. It's their responsibility to manage and lead the strategy of the company to help guide management to success. And a regular cadence of board communications. The public companies I've worked with typically will have a clear board schedule of not only the board meetings, the various committees of the board. So typical committees of the board would be the audit committee. You might have a compensation committee. And having that board calendar setting up very clearly the cadence of communications with the board. And then, as I mentioned, the audit committee. The SEC will expect, as well as your exchanges, NASDAQ and/or the New York Stock Exchange, will expect that you have an audit committee in place in order to be a listed company, public company. So again, there are functional requirements to be a member of the audit committee as part of being a public company. So those are all important considerations as you move into the steps for success. Now, one aspect I want to mention real quick around the planning. A lot of our clients will go through a formal readiness assessment to help identify gaps of what needs to be addressed. And I think that is something I would generally recommend. That way, that those gaps kind of help you develop a roadmap toward ultimately becoming a public company. So some of the challenges around becoming a public company, especially for the finance and accounting group, is the adoption of new standards. And as that title says, it really is magnified. There are certain rules that are applicable only to public companies that will need to be adopted and addressed and fully documented, such as earnings per share, segment reporting. There's some aspects of impairment accounting, goodwill accounting that will need to be addressed because a public company, it's accounted for differently. Accounting for taxes. Historically, most private companies aren't looking at their taxes and calculating a tax provision on a quarterly basis. But as a public company, you will have a requirement to prepare full GAAP financial statements, including a tax provision that is done each quarter. You'll have now a new set of controls and governance in place. Sarbanes-Oxley, SOX 404, is a compliance requirement for public companies. Now, there are some relief. There's two aspects to 404. There's 404A, which is the requirement that companies' management assess their internal controls and attest to their effectiveness. And then there's 404B, which is the requirement that your external auditor will audit your controls and then opine upon them in terms of their effectiveness. Most public companies, as they're going public, would only have to comply with 404A. And depending upon your classification as a public company, and there's several. You may be familiar with the emerging growth company. There's a smaller reporting company classification. Those typically don't require that 404B audit, but the 404A is an attestation that appears in your every quarter in your 10Qs and your 10K, and it's an attestation to the public, to the SEC that your controls are complying. The monthly close. Now, this becomes really important as a public company, and where we've seen some public companies struggle once they do become public, and that's having a timely close. A lot of private companies are comfortable with maybe a very soft close monthly, but really only do those hard closes at year end. Now you've got a quarterly requirement to produce financial statements as a public company. So at a minimum, you really need to think about addressing the process around your monthly close. And does that give you enough time to do all the things necessary to do the external reporting necessary? Start thinking about that as you become a public company. Again, I'll bring this back to lease accounting, and having solutions like EZLease and LeaseAccelerator. If by not having those solutions in place, could significantly delay your ability to close your books on a timely basis. And then a short time horizon, often for that first report. Now, this is sometimes a difference between the SPAC and a traditional IPO. If you're going traditional IPO, the SEC rules allow you up to the later of 45 days to file your first Form 10Q, which is your quarterly report. However, if you're going public via SPAC, because the SPAC, and I'll refer to it as a SPAC sponsor, is already a public company, when you're going through the merger, if you will, and to become a public company via SPAC, there is no such a max 40 or available the 45-day. So it could literally be right around the corner, a few days away. So you've completed your SPAC, you're now a public company, and a week later you have your very first quarterly report due as a public company. So those are just some of the things that you need to think about and that are challenges in terms of being a public company via IPO or SPAC. So what are some of the common challenges for the accounting leaders, the CAO, the controller, the CFO? Accuracy and the timeliness of your financial statements. Again, that is paramount. I mean, even if you're private, to me, it's still paramount. But it becomes so much more, becomes transparent as a public company, and the accuracy and timeliness. Obviously, the last thing any public company wants to have to address is a restatement and have to refile file amended reports with the SEC. It generally doesn't look favorable to your investors and your stakeholders when that occurs. So having accurate and timely financial statements is extremely paramount. And being able to stay current on technical accounting standards. Again, this is an area where the auditors will always be evaluating. So, and what I mean by that is there's an expectation if a new accounting standard comes out or there's any kind of change in GAAP, they will expect you to understand that and apply it appropriately. There's not necessary reliance upon the auditors to tell you how to do it. There's an expectation you would know how to address it. Otherwise, you could be facing, potentially issues from a control perspective. So those are definitely some considerations. Of course, the CFO is always concerned with value creation. Raising additional capital. Now you're a public company. You do have access to the public markets. So the options and opportunities available for additional value creation, either additional capital raising or additional products or services, now becomes, again, transparent because there's expectations of public company that you're going to grow the company and grow the value of the company and ultimately the value to the shareholders. Enterprise risks. Again, here's an instance as a public company that we often don't see in private companies is an internal audit function. An internal audit function is a key to the process to help ensure that the controls are operating effectively. They help give reliance to management and, more importantly, to the audit committee and to the board of directors that the reliability of the financial statements are acceptable. And so those various risks would want to be evaluated, and that's where having an internal audit function can really support the accounting and finance leaders as a public company. Efficiency and cost. Here's the case again. We're evaluating your IT solutions. A lot of public companies or private companies that we work with that are looking at going public don't always have the appropriate systems in place that permit a appropriate level of reporting. So it's an area that you want to really look at around being able to produce, again, timely and accurate financial statements. So bringing together, the right systems and processes that will allow you to not only shorten those close cycles and give yourself more time for the reporting function, the quarterly reviews performed by the auditors, and the ultimate filing with the SEC, but being able to reduce the cost, allowing your team to work on other areas of their jobs and help really support the business beyond just getting through a close. And then I'll just jump over the talent. I think having the right people in place. There's, again, being a public company is just a different mindset. So you want to really kind of evaluate, do you have the right people, and will you need additional resources to support you as you go forward? Well, let's focus a bit on SPACs. So as Colleen mentioned, SPACs were fairly unknown up until the last couple of years, and they really have taken off in terms of as being a vehicle to going public. But they have their own challenges, where the traditional IPO is typically a 12, 18-month process. SPACs, we've done SPACs as fast as 3.5 months. And that was from effectively the date that the target company, or ultimately the company that's going public, signed their letter of intent with the SPAC sponsor, the entity that's already public, to ultimately filing their initial S-4 document. The S-4 is the document, if you will, that you file with the SEC that is essentially explains the pending business combination between the SPAC sponsor and the target, the operating company that is going public, if you will. So everything is very accelerated in a SPAC, and it is very much an all hands on deck. And this is where it kind of gets back to the planning and having a clear roadmap to help manage all the various work streams. Because it's not only about the accounting and finance. You'll have auditors. You could have multiple auditors because the auditors of the SPAC sponsor might be different. You'll have the attorneys. You'll have potentially some investment bankers, and of course management. And so there's just a lot of moving parts, and that's where having a really good roadmap and a good project plan. That's something that we always try to bring to bear on our projects, so that there's a clear path towards success and meeting those deadlines. The second aspect, that second box, the legal and regulatory compliance. Private companies generally have to meet those SOX requirements much quicker than a traditional IPO. Again, generally because the SPAC is already a public entity before they merge with the operating company target. And so those kinds of grace periods often are already used up, and so you'll want to have to start thinking about becoming much more quickly becoming SOC compliant. So that is something that we need to consider if going SPAC is the route that you want to take. And there are some advantages too. Just to quickly touch on that, traditionally what we see is with traditional IPOs is your valuation is much more dependent upon the market as a becoming a public company. Whereas with a SPAC, your valuation is really a negotiated term with the SPAC sponsor. You're negotiating a deal to be acquired by that SPAC. And so that valuation often lends, what we've seen typically has been a little bit higher through the SPAC process, but that's just kind of traditionally what we've seen. And then finally, financial reporting. So the two key reports coming out of the gate in the IPO or in the process of becoming public via SPAC. I mentioned the S4, but then once you've actually gone through the S4 filing, it becomes effective. There is now a proxy vote because the shareholders will need to vote on approving the combination. And then once that combination, once the shareholder vote is deemed complete, and generally it's not more than 30 days, you have 5 days to file what we call the Super 8K. And that Super 8K is essentially your first report that is due as a combined company, a new consolidated company. And so there's a lot of reporting that can happen in a very short period of time. And having a dedicated, a team to support the process is so important to be able to to get this across the finish line successfully.
What do you anticipate will be your biggest challenges in becoming public? So four options there. Bryan, with your experience in working with all of the companies that are doing the SPAC or going IPO, what do you think? If you were going to pick the one on this list that you see the most often and you think is the biggest challenge, what would you say that is?
I generally put A and C pretty much on par, but I lean toward A, but I would say C is a very, very close second in terms of the challenges. And that said, I certainly wouldn't ignore the corporate governance, especially if you have a management team that doesn't have experience with the public company environment. You want to make sure you identify people that can help guide you through that process, and certainly on your board that has public company experience. That's very invaluable.
So pretty much, gosh, an absolute sort of, it's almost just right across the board here, Bryan, in terms of sort of the challenges.
That's interesting. Yeah, I can't disagree. A, B, and C are all fairly close, and I don't think you can ignore one or the other necessarily. So I like those results.
All right. Well, good stuff. Let's move on here to the next slide, kind of getting into sort of the overarching topic of lease accounting that we have today. Bryan, why don't you take us through the challenges of lease accounting?
Absolutely. So similarly to really any other challenge that we've talked about previously, and I think specific to lease accounting and complying with ASC 842, or if you have IFRS requirements, IFRS 16. So accuracy and timeliness. The 842 standard comes with a whole new set of challenges for companies, especially those who are used to a leasing environment where you set it and forget it. Now you really need to actively stay on top of your lease portfolio and the activity that affects your leases. First and foremost, the challenges of identifying your incremental borrowing rates, which is a key term that goes into calculating your lease liability and right of use asset. All those aspects need to be considered, and being able to produce timely and accurate financial statements. And it's just, I can't share that enough, that the challenges that we've seen with companies who struggle and may rely upon either, again, some spreadsheets historically, or really maybe not anything at all. They just sort of, again, it was a set it and forget it approach with their lease portfolio historically.
And one of the things, we put down here in the corner is talent. And there is challenges on talent around lease accounting. We're, it's, I don't think it's easy to find people who want to make an entire accounting career in lease accounting. So there's also that part of it, is making sure that you're able to do this, you're able to do it in a consistent manner, be consistently compliant, sustain that compliance. And in order to do that, you need to make sure you have the right talent, and really you need to make sure that you're equipping that talent with the right technology and solution.
So yeah, completeness and accuracy. These are really the two key audit or accounting assertions that we always look to satisfying when we're working around 842 compliance. So again, have you identified your portfolio? That is, what is your population of leases, whether they're material or not material? Especially as a public company, materiality becomes so much more important because the auditors want to understand, well, if it's not material, please help me understand why. And so that's why it's important, I think, again, to identify 100% of your portfolio. Evaluating for embedded leases. Now, embedded lease is essentially any kind of agreement or contract where, in effect, that you control a specific asset that you economically benefit. It's a specifically identified asset you control that you benefit from. And so an area that we often see embedded leases are such as like hosting agreements, wherein you might have a server or a series of servers at a data center that are specifically identified. Those are your servers. The data center doesn't have the option to use any server in their farm or relocate you or anything like that. So there's a specific asset identified. Those embedded leases need to be identified as part of your lease portfolio. Accuracy. I mentioned the IBR earlier. The incremental borrowing rate is often be a challenging area to address and determine. So it's working with your treasury team, your bankers, to really assess what is the appropriate incremental borrowing rate that I can use for my equipment, for my real estate. Are there geographic concerns? That is, I've got operations and leases in the U.S. versus UK or Europe or Asia. So there's a lot of factors that can come into play and determine your IDR, and having that policy in place that is clearly supported is very key. Having a solution that can provide amortization schedules. What we found, having produced a good quality set of reporting out of your solution, not only does it give you the ability to record your journal entries, but also looking forward and be able to leverage the reporting and its capabilities to address the future. Having a great solution like an EZLease or LeaseAccelerator can really help you in forecasting and planning and budgeting. And that's where reports like amortization schedules can really be helpful. And then most importantly, disclosures. I would say the quantitative disclosure requirements for 842 can be a little bit onerous. And so having, again, a solution in place to do that versus trying to do that via an Excel spreadsheet. We've seen companies try to do that, and it's a significant manual effort, and it's fraught with potential errors. So I think having a good quality solution that produces the journal entries, that produces the reporting, and produces the quantitative disclosures for you is a huge advantage in achieving both completeness and accuracy. Yeah, and so new resources may very well be required. 842 is a new challenge for a lot of companies. As I mentioned, for a lot of companies, lease accounting was generally a set it, forget it. So as long as the lease got paid and you recognized the cash paid or the expense on your books, that was about all you really had to kind of worry about. But now you've got a lease liability, you have a right of use asset that needs to be amortized, you have sort of this potential implied interest component, and so all those, and it goes into all your disclosures. Those are important to have that, to have the people in place to help you lead all that. So let's start with the initial project. Being able to find all of your leases. I would say for a lot of companies that are adopting 842, that's probably been one of the biggest challenges, is just identifying where their leases are. And we have a number of techniques that we've helped clients with, from searching through their GL, looking for potential costs that may be lease related, to looking through their AP vendor files, same thing, but also just reminding, hey, look in your file drawer. Is there a lease document in there? So finding and then abstracting that, being able to digitize and get it into the data so that you can then load into your solution. As we mentioned about policy elections, making sure those are properly documented. There's a number of practical expedients available to you in 842. It kind of goes back to the whole concept of becoming a public company and having all of your key policies, accounting practices documented and supported, and that would include, of course, your 842. Onboarding. Again, now lease accounting is part of your close process, and being able to do that timely and efficiently and reliably and accurately is, as soon as you can, as much as you can take off of your plate and worrying about as a controller or CFO in terms of your close process. I mean, I'm generally all for that. And in my days when I've been in controller seats, I always look to ways to reduce complexity and be able to introduce simplicity and reliability and automation as much as possible. So think about, the resources required to make sure that you can close your books, as well as more importantly here is to close out your lease accounting subledger every month and certainly every quarter and year. Capturing the new leases, having those day two processes throughout your organization that helps you identify new leases or changes to leases, whether that's terminations, modifications, amendments, et cetera. You need to make sure we put in place a policy, an approach, and a methodology that captures those changes.
Yeah, and this kind of moves on, Bryan. Bryan, yep. I'm gonna, the sustainable compliance, because I kind of talked about that, right? The people, processes, yep. and controls. You keep, it feels like we keep coming back around to this, right? The people, processes, and controls. It's important that the lease accounting for that project, for the sustainable compliance, but also for everything around the IPO. We keep coming back around to this, but this is really, this is pretty important to think about, because like an IPO, right, with lease accounting, this is changing your accounting not just once, but it's changing it for every close period, right?
Yes, absolutely. I mean, that's exactly right. And again, I think I would always try to look to opportunities to take complexity out of the process of your close and reporting, and putting in place solutions that brings a level of control, automation, and reliability. And being a public company just gives you a lot of comfort, especially, again, when the CFO, there's expectation that he is signing off on your internal controls every quarter, and he and the CEO. And so being able to give them that assurance is definitely something that you want to have in place.
Absolutely. So let's move on to the next polling question. Being a public company comes with more complex regulations. But I feel like this is an easy one. Feels like a gimme on this one. Being a public company comes with more. So only two options. We're not going to spend too much time here because I feel like everybody will be able to quickly answer this. Look at that. Well, we have 3% who said, no, it is not more complex. I like the confidence there, Bryan. I'm not sure that they're right, but I like the confidence.
Yeah, maybe they're in a regulated industry like insurance or financial services. I mean, certainly those have a fair amount, but it is interesting. Yeah, I'd like to hear their perspective.
All right, well, let's keep moving through here. Bryan, coming back to you about the audit.
Right. So let's talk about pre-IPO, and then next slide we'll talk about post-IPO. And then this kind of summarizes a lot of what we've talked about already, and there's some of the key elements. So first, what we refer to as the uplift of your financial statements from a private company or the AICPA audit standard to a public company standard, or what we often refer to as the PCAOB standard. That can be a significant lift. Again, every accounting position has to be fully supported. Generally, we're looking at anywhere from 8 to 12 detailed white papers and memos that addresses all those key areas. And those white papers and memos will get reviewed and analyzed by the auditors. And oftentimes those memos then go up to their national office for further review and sign off before the auditors agree to those positions. And then just in terms of the footnotes and the financial statement disclosures, those, of course, need to be updated to reflect all the new requirements that would be in place as a public company, both under the public company rules under U.S. GAAP, as well as there are certain SEC reporting requirements that will need to be addressed. I mentioned the documented accounting positions already. The impact of significant transactions. For a lot of companies, they may have acquired a company a year ago. Well, because you're required to present a minimum of 2 years of financial statements in your, either your Form S1 registration statement or your S4 registration statement, you may not have fully addressed all the issues, especially as a public company, for those significant transactions. And so those would need to go back and reevaluate and address, and the auditors could very likely re-audit at a much more intense level that transaction to make sure it complies with U.S. GAAP and SEC regulations. And then fourthly, internal controls and SOX. There's some different perspectives. We've had some auditors, and it seems to be a little bit specific to the partner, I will say, wherein they would expect you have to have already internal controls in place by the time you go public. And so you will often see material weaknesses actually included in your initial registration statement. Material weaknesses around your internal controls. That's not entirely uncommon. We've seen other cases where, we understand that you're a private company before, you had reasonably good controls in place. Now we're given the opportunity to put those controls in place.
I wasn't going to take the audit ones because I sometimes I play a CPA on TV, but I am not a CPA. So I wanted you to do those. But I can talk about technology because I've been working in technology to automate these processes for a long time. So the thing about technology is this incremental work. It's going to be done by people or it's going to be done by technology. Now, you're never going to take people completely out of the process because things like materiality and policy elections and gray areas, right? Identifying those embedded leases, making sure that actually is what it should be. People are going to be in there and involved in that, but automating the processes and having a controlled solution that where you're allowed to you can store documents. It's giving you your audit reporting. This is where you can take your auditors and actually let them into the right solutions and be able to do their testing. Technology is out there, allowing you to do the lease management, right? The data validation, loading, classification, right? Automation of assignment of policies, right? IDRs, doing the generation of journal, actually doing journal entries that will be automatically mapped to your chart of accounts. So this is, being able to do that. And then the lease reporting and analytics, right? Solutions out there, they do have that push button reporting, and this is for lessees and lessor accounting. So technology can automate these processes. More importantly, technology really provides that control vessel, right? Where you have your documents, you have your policy elections, you have your backup, you're showing your work, you're creating reporting out of that one single area. And that's what really it allows you to do two things: have the controls and to be able to replicate that sustainable, right? I have a lease accounting subledger that I'm going into. I'm tracking changes so that I can do this every Q and every K moving forward. And this will take us into our next polling question. What are the key elements of a successful lease accounting plan for a company going public? So we've been talking about all of this today, right? All of it. So I think that we should give people a clue of perhaps, what the answer might be here. Well, definitely completeness and accuracy is up there, which, all we talk about this all the time, Bryan, completeness and accuracy, but definitely all of the above. Yeah. So all of these things are 100% key elements, not only of going public, but then having your successful lease accounting project as part of it.
So developing the roadmap, again, I go back to the very first slide around planning. If you're considering going public in the near term or in sometime in the future, start assessing where you're at and what needs gaps you have and what needs you're going to need to deal with in order to fill those gaps. First and foremost, I think, are your auditors independent under the PCAOB standards? There are some auditors that only do private company audits because they're not listed with the PCAOB, so they're not able to necessarily perform the audits of your financial statements. Do your financial statements conform to those requirements as a public company by the SEC and U.S. GAAP that are applicable to U.S.-based public companies? And again, this is where having that assessment to help you develop the roadmap can be really valuable to help give you guidance to what needs to be dealt with. And then finally, risk management and compliance. Do you have the appropriate audit scope and risk assessments being done to help you identify gaps and be able to do the remediation necessary? Have you addressed, the internal control aspects that would be supported through narratives and control matrices? Have those been created that support your internal control environment? And do you have the appropriate governance structure and an internal audit function that supports the overall reliability of your financial reporting?
So first, I want to say thank you, Bryan. Really appreciate you working with us on this. It's great stuff. It's always great to spend a little time with you and appreciate all the work that you put into this.